This week, we are coming out with two interesting webinars. The first webinar is The Secret to Long-Term Wealth, where we discuss on the behavioral aspect for long-term wealth generation. And the second webinar is The Impact of Tariff in Indian Stock Market, where we discuss the current issue of US-India tariff situation. To join this webinar, click the link below.
There are two types of waiting that we see in this market. A lot of people are waiting on the sidelines to invest. They don't like the prevailing valuations at the headline level in the market. So they think that it is not the right time to look for opportunity in this market. And so they prefer to wait. Portfolios that carry very high cash generally represent that thinking in the mind of the manager, that overall the market looks expensive. I don't want to invest now. I'll hold this cash and invest later. This is one style of waiting. There is another style of waiting where people have invested in expensive parts of the market and hope that whenever sentiment once again recovers, let us say after a trade deal, the space where they have invested will see another spike in valuations. In both types of waiting, I think most people are making one mistake. Yes, it's two styles of waiting. One where people sit with cash to invest, thinking the market will come to where they want it to be. In another, people invest the cash without thinking, hoping that the market will go to where they want it to be. Both styles have an element of wishful thinking, which I believe this market may not fulfill. So, two completely contrasting styles of waiting may both get tested. And why would this happen? This would happen principally because the market is probably going to shift in a completely different direction. Capital flows are going to shift in a completely different direction from where monies have been going right through this calendar year. The color of the capital could change. Where money comes into the market or where the decisive money comes into the market could change based on who is contributing this money, changes in the contribution patterns of those who are already contributing money, and investor fatigue. All three factors will play a significant role in changing the direction of fund flows. Many people think that there is no alternative but to invest in expensive parts of the current market and that the market would continue to invest only there. The assumption is that if there is a recovery in sentiment, these expensive parts of the market will receive more capital. This could happen, but it is definitely not certain to happen. In my opinion, the odds are stacked against this happening, simply because the source of decisive market trend creating fund flows is likely to change. When that source changes from the Indian retail investor to a larger entity, then we are likely to see the style of investing change. Also, the hunger for capital among those wanting to raise big sums of money will at some time completely supersede and dominate the capacity of those providing capital, which is the mutual funds and domestic institutions. This has happened in every bull run. And when that happens, the direction of the market takes a decisive turn. We are probably going to see that sometime in the next few quarters. When that happened, a peculiar thing would present itself before us. Those who manage to raise the capital at high valuations will still struggle to justify those valuations, and the capital will start flowing out of the valuation of such companies. So the contributors to their NFOs or their QIPs at high valuations will lose patience, and that capital has to be provided by those with patient capital. Obviously, if you are going to replace impatient capital with patient capital, the valuation at which this replacement happens cannot be higher, it has to be lower. So, if the market is not going to reward those who have taken higher risks and bought at higher valuations in the recent quarters over the next few quarters, it is likely that a lot of capital that is sitting waiting to see some returns will lose patience. When that loss of patience happens, you will see that impatience turn into an urgency to sell. At that point, you can see valuation crack in several companies. In many companies which IPO'd late 2023 and early 2024, we have seen that crack in early 2025. We are going to see the same thing happen in companies which are IPOing now at higher valuations, but my sense is it will happen much faster than it happened with those IPOs. So while the market is giving capital to people at elevated valuations simply because of the deployment compulsions of large domestic institutional investors, the same market is not going to show patience with the companies after the listing. The hunger for capital among those who are waiting to raise money is at its highest in the history of our capital markets. That hunger cannot be satiated, it cannot be fulfilled by the kind of capital flows we have on the domestic front. We will see a change in the direction of capital flows from the foreign institutional investors, but the money that comes from the foreign institutional investor is not going to where the capital is needed or where the hunger is highest. Typically, what we are seeing in the last few years is capital grows to places where it is not needed, where the hunger is actually low, because it is chasing recency and the biases associated with it. Capital will go to a different place when this earlier money doesn't fetch returns. Now, I think if there is a resolution of the tariff issue and other things, the direction in which capital is going to flow will take a tangential shift. It will go to a place where it has not gone in the recent years. And that in turn will create enormous fatigue in all the places where capital is waiting for returns. Where so much money has gone in, like mid-cap and small-cap, hoping that returns will happen. A year has passed, not much has happened. If returns don't happen in the next 5 or 6 quarters, or even 2 or 3 quarters, I expect investor fatigue to go up significantly. If returns happen in the large cap and headline index because of sudden reversal of capital flows from the foreign institutional investors, this is going to get accelerated. So we live in very interesting times where what we did in the recent past may not hold good in the near future. Clearly, the market is going to show divergence in its behavior from the immediate past to the immediate future. How much this divergence is going to be is what will be very interesting to watch. I am very curious to see this divergence and measure it. I am sure many of you would also be. Let's travel together to see how the market shifts gears, changes direction, and takes swing. Happy investing.